everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. Today, we're going to do a bit of a deep dive. There's been a very, very large move in the Australian dollar overnight, and we're going to get to the bottom of it. We're going to look at why the move occurred, ostensibly. Obviously, one never knows because one can never go and poll every single buyer and seller. But we do have a good sense, I think, of what occurred here overnight, in particular for the Australian dollar and for growth-related currencies that are adjacent, like the New Zealand dollar, for example. And we'll talk about why this move may or may not have follow through. At the end of the show, we should be able to at least have an informed opinion on whether this is something that continues and is a bigger theme, or whether this is something that might hit a wall. And then we'll have a conversation with our good friend Chris about all of the market developments earlier in the day, other than this Australian dollar move as well. So the FOMC minutes, the JOLTS data, we'll touch on all of those things. So as we get started, let's first have a look at what this Australian dollar move might be all about. And needless to say, you can see my bias is right there on the headline. My sense is that this move may not have legs to continue very far. Let's see why. So for the past several years, just by way of background, Australia and China have been at loggerheads. So just to sort of set the stage, the two countries are very important partners in trade. China is actually Australia's largest trading partner. Australia is dominated by its mining commodity exports, in particular iron ore and coal. China is the largest buyer of these imports. Historically, they've over the past several years, essentially barred imports of Australian coal in particular, a few other things as well, like wine and meat, but most notably coal, which of course has had tremendous consequences for the markets. We'll take a look at why in just a second. What we've seen in the past several weeks is a bit of rapprochement. So Australia's finance minister did a visit to China about 2 weeks ago. That was the first official visit in 4 years. We've had sound bites from Canberra that they may drop their World Trade Organization complaint against China if restrictions on coal shipments were lifted. And China has been talking about maybe indeed lifting those as the conversation gets more productive. A bit of normalization with Australia, or at least setting the tone for it, was something that Chinese President Xi Jinping included into his rounds that he was making at the summit conference late last year, and attempting to find a more collaborative relationship with the new Australian Prime Minister, Anthony Albanese, was certainly part of that equation. The outgoing government of Scott Morrison was much more hawkish as it comes to China, and this is really where a lot of the tensions came. They were attempting to call for an independent investigation of the origins of COVID. They were also very skeptical about espionage and intellectual property theft, and in that introduced a number of restrictions on Chinese producers of IT and various other technology for import into Australia. And it looks like with the Albanese administration, there's a bit of rapprochement. And so this is really the active headline here. So we can see overnight, the red line there is the metals and mining component of the larger S&P ASX 300 index. Now, the typical benchmark is the ASX 200. That's the sort of more traditional. This is just a slightly broader index. Same idea, though. And the red line is the metals and mining component, which, of course, stands to benefit and is about a third of all Australian market value. If we take a look at how Australian shares and averages are structured, they're about a third mining, a third finance and banking, much of which is the financial infrastructure to power the mining, and everything else thereafter in much smaller pieces. So you can see there, right as you get the spike in metals and mining shares, you also get a spirited rise in the Aussie dollar. So let's take a look at why that might be and what the logic is. So you can see here, this is the global coal market. And as you can see here, Australia is by far the largest supplier at 39%. Then you have an assortment of others, but focus a little bit on that 8% for the Russian Federation. That one also obviously hamstrung here because of various sanctions, difficulties in shipping, war-related disruptions, and so forth. So consider that between Australia at 39%, which again still being banned by China unofficially, but nevertheless, and 8% that's hamstrung by various Russia-Ukraine related difficulties, be it physical ones because of the war disruption or policy ones because of Western sanctions. You're looking at just under 50% of the entire coal market. And so if China were to source the coal they needed, they would need to put it together across a slew of other much smaller producers. Indonesia, of course, standing out as a particularly sizable one, and not surprisingly, that has been a key outlet for China. Because you will notice this chart right here, the bars there are import volumes for coal into China. And you can see that even though over the past 2.5 years, we've had this tiff with Australia, by far the largest coal supplier internationally, the volumes haven't really changed. We've generally been looking at about the same appetite for coal. So China is essentially having to find ways to fulfill their coal demand without Australia, but to keep it basically apace. And what you see is, of course, the consequences in that green line. That's the Newcastle Monthly, which is referencing the Australian Newcastle port. That's the benchmark, generally speaking, the most liquid international contract for coal. You can see there that against the backdrop of these difficulties between Beijing and Canberra, given that Beijing's appetite has not diminished, the price has soared. So coal has moved aggressively higher because, of course, you still have the world's largest importer, China, in the market, taking in as much as they were on average, give or take, in recent years, but they're having to source it from across all of these smaller producers that are not Australia and, for the most part, not Russia. So sucking in all of that from these other producers, that creates less coal to go around. And so, not surprisingly, the price goes up. This creates scarcity in the market. It, of course, means that China and any other supplier of coal is reaping a premium on the price. Now, of course, this also includes Australia, and this is what you see here. When you look at this chart, it is perhaps a little bit counterintuitive. So let's consider what we're looking at. The green line are Australian shipments of coal to China. And this is the total value. You can see it has basically shrunk to next to zero between 2020, about let's call it the middle of 2020, not surprisingly, just after the COVID pandemic initially struck, and calls for an investigation from the Morrison government emerged. And the orange line is the current account credit. So in other words, the money that is being made from coal exports by Australia. Notice the actual positive contribution in Australian dollars, in millions of Australian dollars, to Australia's current account from coal shipments has soared against the backdrop of this difficulty with shipping to China. And again, that's because of what we are seeing in the overall market structure as a consequence of China's still steady demand. So as the price of coal on global markets soars because China is hoarding non-Australian supply to such an extent, the price that Australia is able to get in selling its coal elsewhere, of course, China is not the only coal buyer in the world, even though it's the largest, that has tremendously supported Australian producers. So they are making much more money selling coal, given these difficulties between Beijing and Canberra, than without them. Why does this matter? So the market's initial reaction, and if we can go back to seeing it here, seems to imply the following. China is Australia's largest export market. If we have these tensions ease, there will be more that again occurs along this conduit. So if China were to again begin to import Australian coal producers, represented here by the Metals and Mining Index, would again begin to reap the benefits of demand from the largest coal importer. That's more coal that they're going to sell, and that ostensibly will mean that there is an underlying inflow of money into the economy. Coal coming out, money to pay for the coal coming in. Needless to say, that's money coming into the Australian dollar. Not surprisingly then, the price goes up. Indeed, to buy Australian coal, you need Australian dollars because that's Australian legal tender. So the expectation is that this would support the Australian dollar directly through additional capital flows, but also to support the economy. And in so doing, likewise, create a situation where maybe economic growth is more robust. Maybe the RBA then could do relatively more on raising interest rates than is currently anticipated. That also would be supportive for the Australian dollar as a secondary effect to what the underlying flows would be themselves. But wait, if this is what we're looking at, then a relaxing of shipments from Australia into China. So in other words, if China were to start to ship Australian coal again, the deficit in markets would ease, because then the pull that China has on all of those other producers' supplies would be diminished, because they would again get access to what is the deepest pool of coal supply internationally. Shortages would be relieved, the price would come down. And so the underlying capital flows into Australia might actually diminish if shipments to China were to resume. The positive support that you would get from these credits, the orange line that you're seeing here, might actually be reduced because the price would come off. And in that, the flow of Australian dollar support might actually be diminished, not increased, in a situation where you have a relaxing of these tensions. And then there is the larger Australian dollar story, which of course is that the Australian dollar, because of its sensitivity to commodities, tends to be very closely related with global share prices and generally the global business cycle. Here we have the MSCI World Stock Index, which is the NWL futures contract, as well as the Australian dollar futures contract 6A. And this is a weekly chart, and underneath is the 13-week correlation between those things, which is about a quarterly correlation. You can see there, it's at a very elevated 0.85 and has been very high generally since mid-year. There was a bit of a blip there in the end of the first quarter, but generally speaking, this correlation is relatively high. And that, of course, makes sense. Commodity currencies or the currencies of commodity exporters, because those commodity exporters tend to be more sensitive to changes in the business cycle earlier in those changes. Those economies, of course, more sensitive because they tend to be at the beginning of the global supply chain, providing raw materials. If you want to kind of visualize the global supply chain that way, you have raw materials producers at the start, value add economies, most notably China, in the middle, that take those raw materials and produce finished goods, and then end demand in the Eurozone, in the US, as kind of the place where those finished materials are then sold. So what you're looking at then is those commodity exporting economies, input exporting economies, tend to be relatively sensitive when the global business cycle seems to turn. So what you then have seen is this close relationship between the market's kind of real-time assessment of that business cycle, namely global shares. Those are, of course, a factor of, broadly speaking, not on an intraday basis, but on a trend directional basis. Those are a function of expectations for earnings of the world's largest multinational firms. Those earnings are, of course, a function of how much those companies are able to sell goods and services, which is a function of employment, economic growth, which shape consumer demand. Household consumption is the largest component of economic growth in all of the world's major economies. So what you're looking at then is not only a situation where, as we said here, the relaxing of these tensions might actually see the money that Australia makes on selling coal be reduced because the price of coal on global markets would come off with easing shortages, but also the Australian dollar's sensitivity to the global business cycle. As you can see here, it has been declining right alongside shares all of last year. We could see a further headwind even beyond that in the slowdown of global growth being engineered by mostly the Federal Reserve and other central banks in trying to combat inflation. So this is a chart we've seen for a few of our recent sessions. I've adjusted here. The bars are purchasing manager indices for the key global economies: China, US, Eurozone, UK. Between the four of those, you have well over half of global GDP. And then the black line there is a global composite. 50 is the center line. Above 50 is positive growth. The farther you go above 50, the faster that growth is. Below 50 is contraction, specifically in manufacturing and service sectors, non-farm, that is. And what you can see here is that in the past 2-3 months, all of the major economies, as well as the global composite, are under 50, which means they are contracting, and are dipping deeper under 50, which means the speed of contraction is accelerating. So this is an environment where demand in general is being constricted. It is also an environment then where the business cycle is turning down and demand for raw materials is diminished. So if this is a relationship that we're watching, we have an inherent headwind for the Australian dollar there, as we can see on the chart here, and of course, this technical one as well. So although at surface level, the markets may have liked what's going on here, it does seem like this move may not have legs, as all of its implications and all of the forces behind it are really digested and absorbed by investors. So this, of course, falls within the larger narrative here of the overall story. And the overall story, as we began the week, was initially one of risk aversion. We saw the markets really swoon at the reopening when markets came back online following the New Year's holiday. We can see over the past 24 hours, there's been a bit of jostling back and forth to find out exactly what that format going forward is going to be. Are markets going to care more about the situation in the Fed's immediate outlook? And we've argued that maybe that part of the story is done. Maybe the markets are done worrying about the amplitude of the Fed rate hike cycle and are focused more on where that that cycle might have implications for growth, for economic stability, and focused less on speculating on the moves themselves and more so on the consequences of those moves. In an environment like that, this kind of a situation that we see with the Australian dollar, of course, immediately is impacted, because if the lens is then a focus on the consequences of tightening, then all the more reason why a move like that might have initial potential and then not build very much momentum thereafter. And of course, in the context of all of that, more stage setting just over the past day. We've had some key developments. We talked about them yesterday. One was the JOLTS job openings number. The second, the minutes from December's FOMC meeting. So let's add those into our conversation here. What we said yesterday when talking about the numbers for the job openings bit first, we initially had the sense that what might happen is if we get a further decline in job openings, the expectations was that we'd get a 17-month low at 10 million, still elevated historically, but the lowest in 17 months, that this might have positive knock-on effect on some of the variables that the Fed is watching in terms of containing inflation. And here we'll just revisit briefly this chart that we looked at yesterday. That is a chart of the JOLTS, job openings numbers, relative to average hourly earnings. That's a measure of wage inflation, and something that will be updated in the monthly jobs report later this week. That jobs report we'll talk about on the show tomorrow in granular detail. So the idea here was, if the Fed is going to see the relationships it needs to indeed dial back policy and achieve a peak in that policy come June, as markets and the Fed seem to generally expect, we should see a continued deceleration in job openings that would feed back and suggest that indeed the slowdown in the labor market is proceeding as the Fed would like, and its goals are closer within sight. Well, as it happens, the job openings number surprised meaningfully to the top side. There really was not a meaningful decline from October into November. Job openings actually held up quite well. And so at about 10.5 million. So the implication here is that the labor market has turned out stronger than anticipated. The quits number, which again, we looked at this yesterday and saw that the theme for much of the past year has been a deceleration in openings, a deceleration in hiring, and also a deceleration in quits, which means people have been leerier about quitting their jobs, ostensibly because the ability to find another has decelerated. We see that the quits number in this most recent report, which we don't have up included in the image yet, that is a little bit, again, higher than anticipated, showing that at this point, job seekers are not lured away from quitting. And of course, when you get quits at an elevated level, you also have people resetting their salaries, which of course contributes to a pickup in wage inflation. We still have more net job openings than we do officially unemployed. And so with that in mind, these numbers suggest that maybe the Fed is not going to be able to move as fast as perhaps they might want on dialing back the situation vis-a-vis rate hikes.